What if I told you there is an account where your money grows completely tax free and when you cash out, it stays tax free forever? That's not some loophole or secret investment trick. It's the Canadian TFSA. In this video, I'm going to break down exactly how it works, the rules for 2025, the mistake that cost people money, and the smart strategies that will help you to build long term wealth. Stick around until the end because I'll give you 5-minute checklist you can follow to set up your TFSA the right way today. So, what a TFSA actually is? A TFSA or tax-free saving account is not just a saving account in the usual sense. It's a registered investment account where all the growth inside it is completely tax-free. That's mean the interest, the dividends, the capital gains you earn in the account never get taxed, even when you withdraw them. You don't get tax deduction when you contribute, but the freedom comes when you take money out. No income tax, no capital gain tax, no nothing. Imagine you put 1000 into TFSA and buys an ETF. A few years later, that ETF is owed 20,000. In normal taxable account, you have to pay tax on that $1,000 gain. But inside TFSA, you can just keep enter $2,000. That's why Canadians love this account so much. Contribution room in 2025. Every Canadian resident over the age of 18 start earning TFSA contribution room. For 2025, the limit is 7,000. If you don't use it all, the leftover carries forward forever. Your total room is the basically lifetime room earned minus everything you have ever contributed, plus withdrawal you made in prior years. For example, let's say you turn 18 in 2023 and become eligible that year. In 2023, the limit was around 6,500. In 2024, it was 7,000. Now in 2025, it's another 7,000. Adds up, and by January 2025, you would have total 20,500 available. That's the room. Log into your CRA My account and check the TFSA transaction summary. That's where the government keeps track. Withdrawals and recontribution timing. One of the biggest mistakes people make is misunderstanding how withdrawal work. You can take money out of your TFSA anytime you want, but it's always tax free. But here's the catch: the amount you withdraw only gets added back to your contribution room on January 1 of the following year. Let's walk through it with simple example. Miguel maxed out his TFSA by September 2025. He then withdrew 3,000 to cover his emergency. A month later in October he decided to put 3,000 back in. The problem is that withdrawal doesn't restore his contribution room until January 1, 2026. By putting it back in the same year, Miguel actually over-contributed by 3,000. The CRA charges a penalty on 1% per month on the excess. So, 3 months of over-contribution, Miguel would have owed $90. This is why you have to be careful. If you need to redeposit, either make sure you still have unused room that's year or wait till January. What you can hold inside a TFSA. The name saving accounts can be misleading. Yes, you can hold cash in high interest TFSA saving account, but you can also hold wide range of investments that include GICs, bonds, mutual funds, ETFs, and many stock listed on the recognized exchanges. Think of it like a container. The TFSA is just the box, and you decided to put what inside it. For example, Anna keeps her 3 months emergency fund inside a TFSA saving account where she can access it quickly. Jake, on the other hand, used his TFSA to buy a low-cost ETF that tracks the S&P 500 because he wants his money to grow over the long term. As some people combine both, keeping short-term cash on the side and growth investment on the other, as long as it keeps qualified investment, you can hold it in TFSA. Opening and moving a TFSA. Okay, opening a TFSA is simple. All you need is a SIN, a piece of government ID, and proof of Canadian residency. Banks, credit unions, robo-advisors, and online brokers let you open one, often in less than 10 minutes. Where people run into trouble is when they move TFSA between institutions. If you withdraw the money yourself then deposit into another TFSA in the same year, you risk over contributing. The safe way is to request a direct transfer between institutions. For example, if you're moving from Bank A to Broker V, you file out a transfer from a Broker V, then handle it move behind the scene. The way the funds never leave the registered system and the contribution room is not affected. Penalties and costly mistake. The CRA takes TFSA rules seriously, and the mistake you can cost you. Over-contributions are the most common problem. The penalty is the 1% per month on the highest exit amount. So if you accidentally over-contribute 1,000 and leave it for 1 month, that's $10 penalty. Another big issue is contributing as non-resident. If you move abroad and put money into your TFSA while non-resident, the CRA charges 1% per month on those contributions, and you don't earn new room for those years. Then there is trading issue. If the CRA decide you are carrying on a business inside your TFSA, for example, frequent day trading, then they can tax your profit. Finally, be careful with swap transaction where you move assets between your TFSA and non-registered accounts. The CRA considers some of this abusive and can apply heavy taxes on them. The takeaway is simple: respect the limit, contribute only as a resident, and don't get fancy with complex swaps. The smart TFSA strategies. Now let's talk strategy. A great starting point is to your TFSA as an emergency fund. If your rents or bill cost $1,200 per month, saving 3 months worth of 36,000 in TFSA saving account means you have got tax-free safety net. Once you build that cushion, start using that TFSA for higher growth investment like ETFs or stocks. The reason is simple: the bigger the gains, the more valuable the tax-free shelter becomes. Another smart move is using both spouses' TFSA. You can legally gift money to your spouses and they can contribute to their own TFSA, effectively doubting your household tax-free growth. For long-term investors, automating contribution is also powerful. Even 300 per month into an ETF inside your TFSA compounds dramatically over time. And finally, don't forget estate planning. If you're married, naming your spouse as a successor holder ensures TFSA transfers smoothly without losing its tax-free status. Let me clear up few questions. Yes, you can have multiple TFSA at different banks or brokerage, but the contribution limit applies to all of them combined. No withdrawals are taxed, but remember, you only get the room back on January 1 of the following year. Foreign dividends are usually tax-free in Canada inside a TFSA, but some countries like in the USA withhold tax at the source, or you can recover it. And if you move abroad, you don't need to close your TFSA, but don't contribute until you return as a Canadian resident. 5-minute TFSA setup checklist. Here is a quick action plan. First, log into your CRA My account and check your TFSA transaction summary to confirm your role. Second, decide your purpose. Is the money for short-term saving or long-term investing? Third, choose your right provider. If a bank, if you just need a savings or gigs, or a brokerage if you want to buy ETFs or stocks. Fourth, if you are moving account, always request a direct TFSA transfer from instead of withdrawing. Fifth, set up an automatic monthly contribution. Even a $50 a month compounds better than nothing. Sixth, track your contribution and withdrawals in a simple spreadsheet so you don't get surprised by CRA numbers. And seventh, if you have a spouse or partner, talk about spousal gift and successor holder options to maximize both of your accounts. That's the complete TFSA playbook for 2025. Remember, the account is very simple in theory, but the details are where people slip up. Use your room wisely, avoid over-contributing, and treat your TFSA like the wealth-building machine it is. If this helped, hit like so more Canadians don't miss out, and subscribe for more practical guided on RRSP, FHSA, and Smart Investment. Drop your age, whether you append on TFSA yet, in the comments, and I'll reply with one of specific next step for you.